First rates, I'll let the screen do all the talking. First rate, it's not going to be a jumbo grand start, and it is not a jumbo grand start. A lot of red, but a little bit of green. The small and the mid cap indices are chugging along. Nifty is trading with a flat bias with a minor uptick of 10-11 points here. The breadth is looking charged up. It's not looking phenomenal, but it's looking charged up nevertheless. Paytm, circuit up. Hindalco, 5% higher. Circuit up for Paytm. Just moving from circuit to circuit. Hindalco, 3% higher. Let's look at some more stocks which are in Swan Energy, 4,000 crore QIP, and it's just sailed through, 761 for Swan Energy. That's there on your screen. ET now broke the story yesterday of this large mega fundraise, and just big guys have participated in it in terms of pedigree. But the breadth is looking decent. The market tone is not looking bad at all, and Zee is down 9%. Yesterday it was up 10%, down 9%. And I'm going to urge to our viewers that wait for clarity. Like they say in English, it's better to play seen rather than blind. In Zee, I think, don't try to play the blind. If the news is true, you will get a lot of upside in terms of where the stock will go. And if the news is not true, then trust me, the stock will see a lot of downside. I don't know what's coming. At least we don't know at ET now. So I would say that in markets, it's better to play seen rather than blind. Don't preempt what is next. Wait for the turns and the news to emerge before you take a conclusive bet on the stock. Anisha?
Well, yes, lots of volatility on Zee Entertainment, but at least the markets at the Nifty level has opened at a fresh record high, so that's something to write home about. But watch out for Devyani International. The block deal happened on that one. Campus Activewear was the other one. There was a large deal that happened ahead of the market open. ABB India, it was a better than estimated performance on margins and order inflow. We are also watching out for Union Bank, that 3,000 crore QIP, which they have launched, will accelerate the loan growth going forward. There were a couple of acquisitions and tie-up that Wipro has done, as well as Tech Mahindra. Let's see if there is any amount of interest on some of those IT names or not. But what's really doing well today, starting on the front foot, is clearly metals, not just Hindalco, of course, on account of Novelis, but Jindal Steel, JSW Steel. These are the stocks which are also up in the trading session. From the two-wheeler basket as well, there is a decent amount of momentum, so not opening with a big red tick, but Hero MotoCorp is something that we should bring up on the radar and see what is that up to. The IT sector has started on the back foot and just tracking in terms of the other movers. You have K-Fintech as well, wherein there was a fresh brokerage note that came out from Jefferies. So that stock has opened with a gap up of around 4%. GR Infrastructure, where there was an order inflow, is also up 3%. On the losing side, it's all about All Cargo as well as Infosys, which are down in the trading session, and so is TCS. But time now to take the first trades with our chartist, Naresh. What has caught your attention?
So ICICI Bank, it would be on any intraday dips. The stock has broken out into new all-time highs. So looks promising. Could be slowly heading up towards the 1150 mark.
Okay, ICICI Bank. So after HDFC Bank, is it the turn of ICICI Bank? But Kunal, what's on your agenda?
Well, I'll go with HDFC Bank as a hold, something which we initiated last week at the sub 1400 mark. Now looks attractive at 1450 levels, and expecting the trend to sustain for HDFC Bank at least over the near term.
Veer Vora joins us. Let's say good morning and hello to him. I turned to my left thinking that you would be joining in the studio. I have to look straight because you're joining us via the link. You're not in studio today?
Next time. This time I had some overlaps.
I had ordered a coffee for you knowing what you like. Now what do I do with that?
Thank you, thank you.
There are a lot of overlaps in the market also, isn't it?
Yes, I think the problem is that especially the global markets are all over the place, and they are so schizophrenic. One day they are worried about the recession in the US, and the other day they are worried about inflation. I mean, you can't have inflation and recession at the same time, not theoretically. So, they are behaving like, headless chickens at some point in time, especially the US bond markets. And that's what's giving me a little bit of, concern about the global situation. So I think, yeah, it's right now we are being more stock specific, I would say, rather than taking big macro calls. It's one of the toughest environments to take macro calls.
What's next now here for the market? Everyone thought that election would be a swing event, which it may not be a swing event. Everyone thought that the earnings season will tell you which way the economy is headed. I'm just trying to understand for rest of the year now, what is next?
So, the hope is that the second half of the year will see a back-ended, faster recovery than expected. While the government is expecting 7% GDP growth, there is a range that I would work with, 6.5 to 7. 7 will be kind of an optimistic scenario. So there are lots of moving parts, and there is some element of optimism on GDP growth already being built into the market. And if that doesn't pan out in the second half of the year post-election, then we might actually, be in for a little bit of a stagnation or correction in the market. Stock specific, of course, there will continue to be opportunities to pick stocks, but a broad-based rally needs to have a broad-based recovery, which is still a question mark right now.
Right now you're not managing public money, but soon you will be managing public money. So when you will start managing public money, what will you start buying in the fund the minute the fund opens for inflows?
Sure. So the view broadly remains the same, that while we are talking about a range of 6.5 to 7 in terms of GDP growth, and we are saying that 7 may be a bit optimistic, but the fact is that India will be a superior economy in terms of growth compared to the rest of the world. So most of the sectors that we are bullish on are domestic, especially sectors where we are talking about the next 3 to 10 years of runway of growth, where we are talking about more domestic manufacturing, more creation of infrastructure, power infrastructure, road infrastructure, other assets like port, etc. So essentially the domestic investment theme. And then as and when domestic consumption picks up, then the domestic consumption theme also. And this, of course, has to be aided by the financials sector, because without financials growing, you can't see growth in credit in the most of the other sectors. So it's the lifeline. So I think we will stick to those segments. Certain segments like, the ones which we have discussed in the past, like the outsourcing from China in chemicals, pharmaceuticals, machinery, defense. I think those themes are multi-year themes that we'll be playing on. So it really doesn't matter when we launch the fund. At any point in time, we would be buyers in these themes.
Fair point. Best Agro has got a 20-year, I'm just reading off the flash. Let it stabilize. Some order win, I think. Mir, in general, if I look at the excitement in PSUs, how much of that is real and how much of that is now euphoria?
I would look at it segment by segment. For example, there are a few in the financial space and some maybe in the infra space also where they're trading at quite high valuations, and I think it's just because of low floating stock. Be very careful on that. The energy pack and the defense manufacturing pack, I think, is still reasonably valued because of the potential. The energy pack is cheap in absolute terms. So it's a whole range out there. There are very highly speculative pockets, and then there are more reasonably priced pockets based on the growth potential. So I would, still be picky. I don't think it's I can make a statement that the whole sector is cheap or whole pack is cheap or whole pack is expensive. You really have to look at it stock by stock.
I'll like to draw your attention to defense, railways, especially PSU defense and railways. What is the benchmark to judge them? P multiple, price to book, order book? I mean, what is the ratio one should look at? I mean, for example, somebody is invested in these stocks and you are a fund manager, you are an expert, you understand that how to value these stocks. So if you have to give an advice to value railway and defense stocks for our viewers who own them or who plan to own them or who want to buy them, how would you give a sense on valuations and the big picture for us?
Sure. So, this theme actually broadly ties in with what we've been, propagating as our investment philosophy, which is that of terminal value investing. People tend to overestimate the short term, but underestimate and quite significantly underestimate the long term in high growth segments and sectors. And that's the value of the stock, which is visible or which can be calculated after the medium term of 3 to 5 years, to say 7, 10 years down the line. What will be the growth rate beyond that is something that we need to think about when we are talking about growth stocks and growth segments. So what happens is that in emerging segments, or and I would say defense, for example, is the emerging segment because it was all PSU, all local manufacturing for local supplies, and that also only for part of the demand in India, which was there locally. But now we are talking about a segment where probably only 1/4 or 1/3 of the manufacturing was local. Now the government is saying that we need to entirely shift to local manufacturing. So then the market size addressable itself goes up by 4-5 times. Then we are talking about the fact that we are going to increase our defense expenditure. And we need to, of course, based on the modernization plan, etc. So then the market doesn't go by 4-5 times potentially, but even more than that. And then we are also saying that private sector will come in. There will be partnerships with private sector and the public sector, and even the public sector outfits can or should plan to export from India. Now, if we are talking about the export potential, then we are talking about a market which is not 2 lakh crores or 3 lakh crores in size. We are talking about hundreds of billions and trillions of dollars. The whole global global defense spending is $3 trillion. So that, depend if you can guess or if you can put a finger or estimate what is the potential after 5-7 years when we actually open up big time into exports. It takes a little bit of time to get the things empaneled, but once it happens, then sky's the limit. So terminal value investing is all about that. I think defense, for example, is a classic example. So I'm not saying a P of 20, 30, 40 is cheap or expensive, but what we do need to keep in mind is what is the total addressable market after 5, 7, 10 years.
Do you see this kind of a large addressable market opportunity?
Absolutely.
Now, where else do you see apart from this?
See, anything in manufacturing, India's total manufacturing base is just $500 billion. And even the US with one-fourth our population is 2.5 trillion. The whole of Europe combined is 3 trillion. China is 5 trillion. China manufacturing is 10 times India's manufacturing. And if multinationals want to shift 10% of China to India, it means that they'll shift 500 billion from China to India, which means that India will have to overnight double its manufacturing capacity. So if we are talking about this kind of shift, plus the 7, 8, 10% domestic demand growth, then manufacturing in India, whether it's chemicals, pharmaceuticals, machinery or machine tools, even durables for that matter, it can have a runway of 10, 20 years before we see single digit growth. So we can grow at high double digit for a long period of time if this mega trend continues.
Mir, are we in for double-digit returns for the equity market for 3 to 5 years? When I say double-digit, let's say early teens, do you think there is a reasonable possibility? Is there a probability of 8 out of 10 that we could be in for a double-digit return CAGR for next 3 years?
Certainly, if you're talking about 3 years to 5 years, certainly that's a possibility. Especially in the large cap indices where the valuations are not that bubbly. We are talking about 15% growth for FY25 and maybe 12 to 15 beyond that also. So I think valuations being where they are, which are a little above average, hoping for a 10 to 13% return on for the next 3 to 5 years is not a stretch, I would say.
How would you approach global denominated sectors, metal, steel, to some extent? Let's say pharma is also global denominated.
Pharma is different because it's much more complicated. There are approvals required. There are lots of entry barriers, and India is pretty much the leader now. So I'm not worried about pharma at all. The global commodities are willy-nilly linked to China. And the fact that even for global commodities like steel, US is encouraging local production. So I would be cautious on the global commodities and metals, including oil, because China doesn't seem to be growing anywhere. And I think it's becoming a structural issue given their demographics and the fact that they have overcreated infrastructure and real estate. So there has been a investment in infrastructure, over investment in real estate, and the demographics are just not supporting it. The hope was that they will shift to consumption mode, which is not happening. The Chinese culturally don't seem to be, getting around to becoming consumers rather than producers for the world. So that I think has a structural problem in the global commodities.
To a fund manager over the weekend, and he said, look, everyone is ignoring the fact that the Chinese currency actually has moved the other way around. And that, in a sense, could be a big challenge going forward if the Chinese government decides to devaluate the currency. The whole process of manufacturing will take a backseat. Right now, it's an advantage which India is getting because of the Chinese currency. And if China decides to devaluate their currency, which they might do to get export back, that could just put a full stop to a lot of great manufacturing export assumptions.
Historically, China has never done, jerky moves. So even if they let the currency weaken, I think it'll be a smoother move rather than a one shot, because the Chinese economy itself is too big, and there are implications on capital flows. If you shock the market, there are implications on consumer behavior of savings. There are lots of illegal ways to take money out if people start getting jittery about the currency, and there are inflation implications also. So I see that as a Chinese shock move in currency as a very low probability event, I would say.
Before we wrap, that coffee which we ordered for you, knowing that you're coming, ठंडी हो गई, अब क्या करना है?
Sorry, could you repeat that?
No, the coffee which we ordered for you, knowing that you would be joining us in the studio, ठंडा हो गया coffee, अब क्या करें?
Save it for next week. I'll be there.
Look forward to it, but I promise you, we'll serve you not a cold coffee, but a hot cup of coffee early in the morning.
Thank you so much.
Well, talk about a stock which is just not hot, but is sizzling hot, and that's Keynes. Went public at sub 1,000. Now it's like the real darling. It's been almost like a 4x from its listing price. Jairam Sampath, whole-time director and CFO of Keynes Technology, joins us now. You went public closer to 700, if my memory serves me right.
Yeah, the issue price, good morning to you all. Issue price was 587. And I think on day one, we got a good...
7 has become 2,800. You've been a multi-bagger in less than 1.5 years. Must be a great feeling, right?
Yeah, I think a lot of kindness by investors and the general public, and I think more importantly, our customers, which is the basis of all these results.
Thank you to media also, sir, for a change. We've also...
no, of course. Media is an integral part of public, and probably you are the first step towards any information that goes to people. So I guess media deserves its fair share.
Thank you very much. It's been such a pleasure to see what good work is happening there. My question to you is that you've reaffirmed your guidance of 1,800 crore. Is that what's giving you confidence that you will be able to do 1,800 crore?
So our business, like I have said earlier, it's a little bit of a longish term. It's not a quarterly business. We, if you see the December 31st, we had an order book of about in excess of 3,800 crores. So some of those orders are meant for this quarter, some are for the next year, and then there are some orders which are FY25 and FY26 as well. So we have full coverage of orders for this quarter. So it's a matter of execution, receipt of components, making sure that all the manufacturing is done. So we are sure that should happen for this quarter.
The historical challenges which everyone had, lack of components, semiconductor availability, supply chain issues, all that is sorted.
Yeah. Okay, let me put it this way. The environment has improved a little bit, but I think we have also improved our response to the environment. We are a little sharper now in terms of identifying those which are likely to be bottlenecks, and then we make sure that we take some extra precaution, while at the same time making sure that we don't excess stock, because we are also having the responsibility for keeping the working capital within some limits. So yeah, environment has improved a little bit, but our response has improved very well.
Help us explain this entire Aptus technology collaboration, what it means for you.
Yeah, so we have got 3 collaborations in the semicon area. And one of the things that whenever I have talked to people, I've been always saying that a company wants to be an integrated EMS player. So when you say integrated EMS player, earlier the definition was that if you made plastics and metals and you did assembly, then you become a comprehensive EMS player, contract manufacturer. But today what has happened is in the kind of technology development that's happening, there's a lot of micro miniaturization happening. At some point in time in future, a lot of assembly work will reduce, for a given product, for the simple reason that some of those components will morph into a small silicon wafer. And then, of course, value has to be added by some company which converts that wafer into IC, which is essentially an OSAT company. So our destination in our OSAT business is to do high-end OSAT, which includes things like compound packaging, which includes things like advanced packaging, compound semiconductor, and of course modules, which we in our imagination looks like it will become more and more prevalent going into future. So while we have to start with a partner like Globetronics, which is in Malaysia, for the basic semiconductor assembly, because we need to learn the ropes first, and then the second stage wherein we wanted to learn the advanced packaging. And as you know, India has lost a lot of time in semiconductor, both, especially low side business. So we need to leapfrog into the higher end semiconductors so that we are future proof. We are able to take care of all the future requirements of the customer. So in that context, people like Aptos from Taiwan and EOI of Japan, they become very important actually, because they have already capabilities in advanced packaging. And so they bring also with them the respective ecosystems of their nation. So essentially, the way to look at it is we are being helped by Malaysia, we are being helped by Taiwan and Japan, which is the best kind of combination.
I have an Axis Capital report with me, and the projections are that this year you're on course to do between 2,500 to about 3,000 crores of turnover.
FY25.
FY25.
Yes.
So is that a fair estimate that you would be somewhere in that range?
It will be between that, though we may not be able to give you guidance right now, but that's a fair estimate. Going by the order book, etc., that's a conclusion we can make. Yeah.
What visibility you can share with us for FY26? Because the order book what you have will not be executed in FY25. It will be in FY26. Yeah, please.
So our order to book, book to order is typically 1.5. So typically what we are saying is on an average, we have order book for about 1.5 years. So FY26, I can confirm to you that at least the growth rates will be the same or if not higher. So anywhere between 2, 5 and 3 is the kind of target for the coming year based on whatever order books we are having. So I guess between 40 and 50% growth is likely for the FY26. FY26 might be one more additional benefit will be there. In the second half, our semiconductor revenues will also kick in, and some little bit of PC board revenues will also kick in, because by that time we would have completed at least bulk of our installation of our production facility. So if FY26 may, certainly you can expect whatever FY25 numbers are there, at least 50% kind of growth on that.
15% growth on FY 50. Yeah. I thought 15. Okay, thank you. Okay, can I say that this kind of a growth, as the base becomes higher, could be there for next 5 years at least? I'm not talking about an absolute guidance, but directionally, can you grow at 40-50% for 3 to 5 years?
Yes. So in terms of capability to grow, see, one of the things people, the investors and analysts, everybody asks me is that will the company be able to sustain its growth by its own merit, by generating reserves and cash within the company? So the answer to that is yes. As of FY25 end, we have worked this year. There will be some small improvements in our net working capital. Next year, some more. And by all analysis, it is telling us that our EBITDA numbers will also probably improve in terms of percentage. So with this kind of a situation, we will have a good operating cash flows. So we will invest more and more into FY26 and for FY26 capacity. Similarly, FY26 will generate some more cash, and then that part of it will get invested for FY27. So the hint here is that demand is not the problem. Problem will be capacity creation. And so that's what we are now working on. We are making sure that we have adequate representation for the company across different states, and we are acquiring land and starting off, at least in some small way, making sure development is done of the land, and we start planning for additional capacities, because FY25 is just around the corner, and post that, FY26 will be staring at us. We require at least 6 to 9 months to develop any capacity for usage. So yes, so this growth will continue for 5 to 10 years for sure. And we also, as I always said, what we do today, what we perform today is a result of something that we did in the past, maybe 1, 2, 3 years ago. So now we have to work for a life beyond this 5 years time. So we have to set in motion processes and diversifications into different types of categories, so that we can sustain this growth in a nice way. The nice way is to maintain all your profitability and all your other objectives. At the same time, making sure that the company's size grows and its sphere of influence grows.
My last question to you is that, okay, growth of 40 to 50%, that's a very large growth. And the kind of numbers what you're telling us, sir, that means we are looking at about 400 to 450 crore of profit by FY26.
Not giving a guidance, but it's doable. Yeah.
doable. And you're confident that you will be able to expand your capacity. You've got all necessary clearances. You will have no problems in terms of technology transfer. You're not worried about that.
Yeah. I don't think that's a worry. So, like I said earlier too, today the job of companies such as us and other peer groups who are also growing at a high speed becomes not only achievement of production targets for the year, but also look at coming years and then make sure that your capacity formulation is there. It's not as if it's very easy to get business or something, but that is something that we have figured it out and we have processes in place. It's the project execution that are the skills that companies like us have to learn in order to grow to larger numbers.
What could go wrong? I mean, could it be pure global risk factors which are unknown right now, or there are supply chain issues which you are assuming that they would be sorted out, but if they don't sort it out, you will be forced to go back? Could competition come back? Could there be a new technology which could threaten your existing order book? I'm just trying to understand that every business has a risk. What is the risk for you?
Yeah, and I'm glad you asked this question because one of the things that keeps us awake is the fact that, okay, one thing is that the view looks very positive and sometimes, you can even say it's too good to be true, right? So obviously there is some, there is somewhere lurks a few challenges. One of the challenges which we have tried to address through our OSAT plan as well as the high density interconnection board is technological changes which forces these micro miniaturization of boards so that the salience of assembly comes down. So that we are kind of addressing by making sure that our technologically we are ready to add value, even if such a situation comes wherein the micro miniaturization of board happens and then the number of components to be soldered for a particular application comes down. So the other risk, which in today's world has become well and present, is the risk of global supply chain disruptions. So let's put it this way: these disruptions are minor in the sense they are 1 month, 2 month kind of disruptions. So in our kind of business, if you plan it well, we can make sure that we don't get too much affected. Yeah, some 1 month, 2 month, we could have some little difficulties. So I don't expect these global disruptions to be of that nature. The last point, which is really always a challenge, is to get the required talent, because now it's not only another 2-3 years time, will not just be one product or one manufacturing system company, right? There'll be OSAT, there'll be PC boards, and who knows some more. And what ends up happening is that we have to make sure that all the talent, proper talent for execution of these projects and then making sure that operations are done, that has to be put together and retained and so on. We're making a lot of efforts. So that's also the reason why we are also launching newer, let's say, subsidiaries, etc., so that we give enough leadership bandwidth to people. See, one way of growing talent is to grow leaders. And that is what we are focusing on. We are onboarding people who then will obviously grow their teams, etc. So talent growth is one issue. Otherwise, the other things are all challenges which can be addressed. These are challenges which we need to work right now so that after 3-4 years' time, we are able to kind of get a handle on these problems.
Okay, building on the capabilities as well as getting the second round of leadership in order, that's one of the priorities. Thanks so much for making time and speaking with us today. That's the management of Kaynes Technology, expecting that 50% growth to kind of continue. Just quickly taking stock of some of the big buzzers. Take a look at Campus Footwears. That stock is up 11%. That block deal happened. Stock opened with a gain of around 2 to 3%. But from there, and let's pull up the intraday chart because that will tell you actually the kind of move that we are seeing. That stock is up a good 10%. You also have GIC, which is up 8%. ABB posts its earnings and that margin and order inflow beat is showing a stellar run of 7%. Paytm, Chemplast, Samnar, Union Bank, KFin, these are some of the other big buzzers. And of course, Zee Entertainment, which has seen a massive drop, almost 10% cut on that one. But time to put the spotlight on Zaggle Prepaid Ocean Services. Avinash Gorkindi, the co-promoter, MD and CEO, joins us on the show. They have been doing a lot of partnerships. So let's try and understand whether that is expected to accelerate the revenue and what kind of numbers should we expect. Avinash, hi, good morning. Good to be speaking with you. Well, we have seen a flurry of orders come by, whether from Quest Corp, tie up with Axis Bank, etc. Which segments are you seeing the maximum inquiry from, and when will the revenue accretion start from all of these orders?
Good morning, and thank you so much for having me on the show. Yes, we are seeing very robust growth, both in terms of partnerships and corporate customers sign-ups, including Bennett and Coleman, which we signed up yesterday. So we are seeing growth across board, and we're basically seeing this growth because increasingly the market, whether it's partner banks or corporate customers, are recognizing the fact that here's a profitable SaaS fintech which is listed, which is very conservative, which has 11 partner banks, high quality banks, and they get the confidence that we are doing something right, to be honest.
Yeah, clearly you're doing everything right, it seems, at least at the moment. But you know what? Revenue growth has been still a bit sluggish, 8% I think is what you clocked in the quarter gone by. Though the profitability has seen a massive jump, that's also because the scale is actually coming at play. What's a sustainable number? If I look at FY25 now, what kind of top line and profit figures are you targeting?
See, revenue growth in our business, all numbers, because there's a significant seasonality, we look at it on a year-on-year basis and not quarter-on-quarter basis per se. And year-on-year, we are already growing at about 37-38%, and we've given a guidance of YOY growth of about 40 to 50% for this year and 40% plus for the next year. And we are absolutely on track to achieve those numbers. So from a revenue growth perspective, we're seeing very robust growth, and we saw tremendous growth between Q1 and Q2 as well, right? So we were at about 118 crores, and from there we got about 185 crores in Q2 and about 200 crores last quarter. So if you look at overall the growth in the year, it's been very strong. We've crossed already 500 crores of revenue this year. Last year we did 550, and already 500 as of Q3, right? So 31st December 2023.
Yeah, so you had laid out a target of 40 to 50% growth for FY24 and looks like you're on track. But my question is, will this kind of growth rate sustain in FY25? Because the base will get heavier. Do you expect to maintain this 50% kind of growth? Are you looking at a 750, 800 crore revenue number in FY25 then?
So FY24 would be that number.
25 would be 1,000, 1,200?
We've given a guidance of 40% plus growth, and we stand by that because we see tremendous tailwinds for our business. We see tremendous operating leverage kick in. We see a lot of benefits of being the leading player in this space. A lot of times, you do a lot of hard work for years, and all of that comes together, and all the stars align, and that's the space that we are in today. We believe we're seeing a lot of tailwinds for our business, and the model that we've built painstakingly over the years, where we've diversified revenues, partner banks, networks, industry segments, all that has started to really help us grow very rapidly.
Avinash, I think you've done a lot of meetings in the GCC region as well, right? And looking at expanding partnerships there as well. Talk to me about what's the strategy there? What kind of opportunity do you envisage for yourself in the West Asian markets?
See, these are very preliminary. We've had discussions both in Southeast Asia, in GCC. We are talking to people in the US, and these are initial discussions that we are having to understand the lay of the land, what's the right strategy. We've always believed in being very calibrated with these decisions. We see really tremendous growth in India, right? We see opportunities in these markets, but we also understand that we need to be cautious as we venture into these markets. Having said that, the response that we are getting from these markets and partners like Visa and other partners who are helping us talk to banks and other stakeholders in these markets to bundle our software solutions with the corporate credit cards and purchase cards of these banks in those markets is phenomenal. So we are getting a lot of positive response. We just want to be very meticulous in our planning as we enter these markets. Just to give you a sense, when we were trying to launch our credit card business, we spent a good year and a half plus just to plan it out and do the legwork to build that business. And we've seen tremendous growth this year in that space.
Okay, I'm just trying to understand that what kind of regulatory layer actually you have to, in a sense, monitors you. Since you are not accepting deposit, do you think the regulatory layer in terms of RBI and other regulations, they don't apply to you?
Good morning, Nikunj. See, end of the day, we are working in partnership with banks, right? And we are guided by all the directives and compliances that banks ask us to adhere. The issuer of these, prepaid cards and the corporate credit cards, purchase cards, is very clearly the bank. So while we're not directly regulated by RBI, the directives do apply to us as well, because they apply to our partner banks.
After what's happened to a peer fintech, would you be looking at expanding in areas of wallet? Would you be looking at expanding something in other areas of fintech?
Look, I think we have enough growth opportunities across. We are today on the expense side of a corporate customer, right? Whether it's vendor payments, whether it's employee payouts, whether it's channel payouts. Apart from budgeted capex, we cover the entire gamut of spends that corporates incur, right? And we see tremendous growth there because we just scratched the surface. Digitization, the need to be compliant to reduce leakage is huge. There are opportunities to look at, accounts receivable, for example, and there's demand from corporate customers for us to offer something in that space. And we are constantly looking at other, EBITDA accretive areas, profit pools. Forex is something that we looked at, and we've done a partnership with Visa, and you will hear about our Forex programs in the coming financial year. So we're constantly looking at profit pools and areas where we can expand profitably.
If I have to introduce, let's say, ZEEL to our viewers, can I say that it's a technology company which is giving financial services, or it's the other way around?
Well, we are a SaaS fintech, Nikunj. That's how, or tightly couple it with fin products which are issued by partner banks. And we take the bundle to corporate customers. We, help banks take that bundle to their customers as well. So because in a customer's mind, and when I'm talking of a customer, I'm talking of a corporate customer or even a user, an employee of these companies. The Times of India employee or ET Now employee wouldn't care whether I'm providing fin solutions or tech solutions. They want a seamless experience. They want things to work for them. They don't want to have to worry about their money. They want a Amazon type of user interface. And that's what we endeavor to provide.
Finally, what are the chances that the service which you provide could actually itself get disrupted by either a new service provider or some of your current clients, which is Visa and other companies? They may actually eventually start doing the same work. I'm asking you this because if I look at the technology industry now,
Yes.
A lot of big clients they've started setting up their own global outsourcing centers. What are the chances that if this is such a critical part, the existing companies can start, hum bhi chalu kar dete hain?
Great question, Nikunj. Thank you for that. See, our business has three pillars: software, banking partnerships, corporate relationships. And this business, we honestly believe, can be built and run profitably only if you have all these three pillars covered, right? And building a base of enterprise customers or bank partnerships or a great software platform for that matter takes years of work. The second thing is, if you look at banks, our platform today, for example, integrates with the bank platform on the one side, and we integrate with corporate customers, ERPs, their HRMSs, etc. For a bank, it doesn't make sense for them to have hundreds of ERP integrations with their core banking system or their card management system. No bank that I know of, and I've spent a lot of time working with banks around the world, would want to take that risk. They would not want their system to be directly connected to a ERP, an HRMS, a CRM of a corporate customer. And that's where our labs, really fits in beautifully. We get insights from the card transactions, we get insights from the corporate ERP, and we get information from there in terms of project codes, cost codes, location codes, etc. And we marry all of this and give you great insights about who's spending, how much are they spending, why are they spending, who's approved it, and how does it compare, year on year, month on month, across locations, across project codes. That whole insight is extremely powerful for the corporate CFO.
All right, really appreciate your time. So glad we had a very engaging chat, and I would love to understand your business model more. I mean, as we grow old, we are realizing that how technology is changing our life. But thank you so very much for breaking it down so brilliantly for our viewers.
Thank you so much, Nikunj, for having me. Always a pleasure.
Thank you very much. Well, Zagel said out of the park. Just a coincidence that Kane and Zagel, they both are part of Ravi Dharmashi's portfolio. They both have done well, and we had both the managements today. And that's what it is. I mean, who says that IPOs don't make money? If you get the right business in terms of the right theme and directionally where things are moving, I guess it went public at 140, 150, if my memory serves me right. That has become 280, not even in a year. Harmon H. Sani joins us, Chief Executive Officer with Raymond Realty. Good morning. Thank you for joining us. I can see your boards when I'm in Bombay, big boards across town. So Raymond Realty is now a reality. That's a nice line. Raymond Realty is now a reality.
Thank you so much for having me, Nikunj. So it's a pleasure to be on the show. Yes, you're right. You're seeing our marketing campaign. That's all part of our launching our new project in Mumbai. We've been in Thane for the last 3 years. So now we are expanding our footprint into Mumbai. So that's the reason why you're seeing those hoardings and the marketing campaign.
One is that you're developing your existing land bank, which is the old mill land historically owned by Raymond. You've started constructing on that in Thane. But you're also developing land banks in Bandra. You're also developing land banks in other parts of Mumbai. Why are you doing that? Because you have such a huge legacy land advantage. Why not just build and make that big?
So obviously, there are business reasons for doing this. One is the concentration risk, which needs to be diluted, because if we are in one location and there is a limit to how much absorption that can happen in that market. Since this is a business that we are serious about and we want to grow it to scale, the ambition of the group is quite large in this space. So that ambition, that hunger is not going to be fulfilled by just developing the Thane legacy land. So we have to expand, and that's what we've done in the last 2-3 years. And that's the mandate with which I actually joined the team, and we've taken it forward over the last 3.5 years.
Since your land bank is in Mumbai, and that's where you are right now developing, and I mean both land bank and JVs are in Mumbai, the landscape of Mumbai is changing. One bridge coming from here, one bridge coming from there, a lot of undergrounds coming, metro coming in. How will that change? Because ultimately housing is about accessibility, infrastructure, and how the map of the city is moving. How will the dynamics change for you because of this infrastructure development?
So infrastructure development is always good for the real estate business, and it's essentially good for the city and the general population. So anything which is good for citizens is going to be good for real estate, because we are trying to fulfill a basic need. One of the roti kapda makan is the basic need. So as far as Bombay is concerned, I think Bombay was lagging behind in terms of infrastructure, and there have been lots of large plans which we have heard over the last 20 years, which didn't come to fruition. But in the last 5 to 7 years, we have seen a lot of work going on, whether it is metro, whether it is road network. All of this is great. And we've seen the other cities in India develop. For instance, Delhi has fantastic infrastructure in terms of road network, in terms of metro that you see. So I think it is something which is very, very positive. It is good for existing areas which will be better connected, and it will also grow the market. Bombay was lagging behind a little bit in terms of competitiveness because of lack of infrastructure. If you look at the data, we've seen actually reverse migration in Mumbai city, the island city, and people have moved to the suburbs. The reason for that is commuting times are very large, prices have gone up. And a very big reason of that is lack of connectivity and public transport. Now, public transport coming in, private transport getting facilitated through better road network, I think it will add to the competitiveness of the city. It will go a long, long way.
Definitely, the infrastructure is definitely picking up. But I just wanted to come back to that Bandra project, because I remember you were talking about a revenue potential of 2,000 crores from there. When will it start kicking in? And I understand that this is done with a development partner. Could you talk to us about, have you identified someone?
So, see, this is a redevelopment project. There are about 10 societies which our partner had aggregated over a period of time. So we have partnered with that person. He's got a minority stake. Essentially, we are more than 90% in the project. So the role of the partner essentially was to get the land to us, and everything else we are doing. And the real consumer that we are serving in this case are two. One is the existing society where we have to give them houses, which is on a separate piece of land that we will do. And the central core portion of the land will be for the consumers, which will be Raymond consumers, where we will be selling them. So these are two independent projects, one part redevelopment and one part we will be doing for sales itself. And your second part of the question was, when will it kick in? We launched the project yesterday evening to all our channel partners. We unveiled all the details. So it will start kicking in from next financial year, which is April 24 to March 25. So you will start seeing in our P&L the result of this project. But the work has already started. The construction has started. The sales will be starting from today onward.
So are you following what could be called as like a cost plus model? I mean, the realty business is structured around land, which you have built on it. That's cost plus. Joint development, you're putting in capital. Somebody gets the land. Again, it's a cost plus model.
No, realty business is not a cost plus model, at least the way we are doing. And JDAs principally are taking an equity bet you're doing. But the only difference is that when you buy land, you're putting your equity in land. And then for construction, you either get funding or part equity. And even buyer's equity funds that, the way things are in most parts of the world. Buyer's equity also plays a role. But in JDAs, we don't put our equity in land. Land is brought in by the landowner, or in this case, it's a redevelopment for Mahindra. So the society has the equity in land, and they will get paid off in terms of redeveloped area that they will get from us. So our equity and debt funding, whatever we do, will be in the form of construction and approval costs that we would be doing. So that's the key difference between buying land and JDAs.
There is this benchmark which we use in the real estate sector. That real estate cycle comes for 5 to 7 years, and then it goes flat with a downward bias for 5 to 7 years, then it comes back. Where do you think we are in that cycle in Mumbai?
So actually, this time around, if you see, the down cycle lasted longer than usual. And even the down and up cycles over the last 2 or 3, maybe 3 cycles, it has not been as predictable as it has been in the last 50, 100 years. And these are cycles which are not just Mumbai market, they even transcend beyond country. So even globally, we have seen these 7 to 8 year cycles, whether it is the Western market or east of India that you see. But for the last 3 cycles, since this globalization which has happened and kicked in, the world has got so integrated that these cycles have been very erratic. Sometimes, last to last cycle, down cycle was just 2 years, and then it bounced back. And the last down cycle that we have come out of just 2 years ago was almost 8.5 year down cycle. Of course, the real estate in India saw some structural changes as well as the cyclical changes which happened, because with the advent of RERA, GST, also in Bombay, we had the new DP plan coming in 2034. So those were the structural changes which happened, and it coincided with the down cycle. So it was a double whammy for almost 8.5 years, which we came out of about 2 years ago. And I think the entire industries came out of it with a bang. And of course, there was also pent-up demand for the last 8-9 years. And then after COVID, there is anyway revenge buying which happens, especially large ticket items, whether it's cars, houses. Every large crisis in the world has seen that the big ticket items have an upcycle right after that for almost 2-3 years. So we will probably see a double wave So one wave is because we've come out of COVID and people have been reminded of their mortality. So they want to quickly fulfill their desires and do whatever they thought they've been putting off. And of course, the real estate upcycle has also begun. So I think this time around, this cycle will probably upcycle will last longer because of this twin factor. And to answer your question squarely, I think this is the end of second year that we are in that cycle. So there is a lot of steam left in the market.
Okay, a lot of steam left in the market. Thanks so much for making time and speaking with us. Appreciate you joining us on ET Now. Quickly marking what's happening in the stock-specific action right now. New India Assurance and GIC, both of those public general insurance companies are up anywhere between 9 to 14%. ABB has now managed to inch higher by 8%. Watch out for Piramal Enterprises. Good amount of volumes and that stock is up around 6%. And Union Bank of India, post that QIP news, is also seeing quite a bit of gain. But time now to slip in a very short break. Don't go anywhere.